It is a crisis, and I think it's very much akin to the crisis that we saw, well, our grandparents saw, in 1929. You have the first leg, where there is the panic. The panic subsides, the authorities come in, they will do the same. They will have to panic and cut interest rates. The Fed comes in, has to rescue the situation. Calm is restored for a number of months, and then the real decline starts, and it's very pernicious.
Investors were thrown into turmoil this Monday as global stock markets, including the S&P 500, FTSE 100, and Nikkei 225, experienced significant sell-offs, raising alarms about a potential global recession. The catalyst behind this market volatility was the unwinding of the yen carry trade. For years, investors had taken advantage of Japan's near-zero interest rates by borrowing yen to invest in higher-yielding assets worldwide. However, when the Bank of Japan unexpectedly raised interest rates by 15 basis points, causing the yen to appreciate sharply, investors rushed to close their positions. This mass exodus led to a widespread sell-off across global markets. Adding fuel to the fire were conflicting economic signals from the US, which deepened uncertainty. While some indicators like GDP growth showed resilience, others hinted at a slowdown, causing the activation of the S&P rule, a historical predictor of potential recessions, which further stoked fears. The tech sector, a key driver of recent market gains, was hit hard by disappointing earnings from giants like Amazon, Microsoft, and Tesla, causing their stock prices to tumble and dragging the broader market down with them. Despite these worrying signs, many analysts view this downturn as a market correction rather than the beginning of a prolonged financial crisis. However, Alasdair MacLeod, a well-respected precious metals analyst and head of research at Gold Money, offers a more sobering perspective. He suggests that Monday's crash could be the crash before the crash, a prelude to a more severe and extended downturn reminiscent of the Great Depression. MacLeod points out eerie similarities between the current market conditions and those leading up to the 1929 crash, warning that we may be on the cusp of a much larger economic crisis. In his recent interview with Liberty in Finance, MacLeod dives into these pressing concerns, drawing on both historical insights and current market trends. As we share key clips from this eye-opening discussion, make sure you subscribe to the channel. By subscribing, you'll get early access to expert analysis, timely updates, and strategies that can help you stay informed and ahead in these unpredictable times. And don't forget to turn on notifications so you never miss a crucial update.
Individual events occur, and you're right, it's difficult really to assess the importance of those events until they play out. But I think by far the most important thing to understand in terms of market valuation is the disconnect between bond yields and equity indices. Usually what happens towards the end of a bull market in equities is that you find that economic conditions are such that interest rates have already started rising, bond yields have already started rising, a tension develops between the valuation of the equity markets and the bond markets, and it sort of pulls apart like that, and then suddenly it snaps. This is, I think, what we're seeing. If you chart the 10-year US Treasury yield, invert it and put it alongside the S&P, you will see that an inverted yield and an S&P generally correlate pretty tightly. There have been exceptions. The first big exception was the dot-com bubble, and in the years following that. The second big one was COVID, where with the suppression of interest rates to the zero bound, the yield on the 10-year US Treasury just collapsed down to less than 1%. The third one, which is the one we're in now, is the biggest disconnect in terms of valuation that we have seen in history. Now, it is closed a little bit with the yield on the 10-year US Treasury coming off a little bit, and at the same time, the S&P 500 itself coming off a little bit. So that gap has closed a little bit. We are now in the situation where having the S&P having continued to sort of climb while bond yields were climbing, that disparity is so great that the snap is now in place. It's just a question of what triggers it. And what has happened is that the institutions in Japan in particular over many years have sought higher yields abroad by investing in foreign bonds, particularly US Treasuries, and also some of the European bond markets as well. They have also invested quite a lot in US equities. So we have this situation where with the outflows of capital accelerated by the carry trade, as individual institutions in the US and elsewhere would rush out and borrow yen in order to sell the yen to buy dollars and then invest the dollars in T-bills for a yield pickup really of about 5%, leveraged up so that your return on your underlying capital is probably 50% if you leverage it up 10 times. You can see how this thing was taken to excess. And this was why the yen rate against the dollar fell from around about 100 to about 161.5, which was the lowest level for the yen. The numbers are upside down, incidentally. You need to invert the chart. And then everybody got wind, if you like, that the Bank of Japan was going to change its policy and actually raise interest rates from 0.1% to 0.25%. Wow, what a shocker. But what it did was it triggered an avalanche of reversal of the carry trade. As suddenly there were huge losses on the capital side of the carry trade, particularly where people actually hadn't covered for the exchange risk. And at the same time, you were finding that the Japanese pension funds and insurance companies were making, I mean, they were facing quite big losses where they were going out into term debt. And so really what they were doing is they were trying to liquidate their foreign positions as the currency was recovering, because the currency was wiping out any profits that they had or making their bond losses even worse. So they were basically selling dollars, buying yen.
While there's ongoing debate about whether the unwinding of the yen carry trade is truly over, Mark McCormick, the global head of FX and EM strategy at TD Securities, recently emphasized that this process is far from complete and deeply embedded within the financial markets. He noted that over the past decade, Japanese pension funds, which represent a significant portion of Japan's GDP, have heavily invested in foreign markets. These investments form a critical part of the carry trade. McCormick highlighted that we still have a long way to go in the unwinding process, stressing that this issue is both tactical and structural. The assets tracked by Japanese investors in foreign markets have become a substantial component of the carry trade, and the ongoing unwinding could continue to influence global financial stability. Alasdair MacLeod, a respected analyst in the precious metals sector, also anticipates further unwinding, not just in the yen carry trade but across various sectors of the global economy. This could signal more volatility ahead as markets adjust to these shifts. Let's dive back into the video to explore what this could mean for the future of global markets.
The selling of Japanese institutions' interests came at a very difficult time for the US market, because it was about that time there was some disappointing earnings coming through from, the Magnificent Seven, the top tech companies. And so you had this combination, if you like, which was driving down equities. And it is a crisis, and I think it's very much akin to the crisis that we saw, well, our grandparents saw in 1929. You have the first leg, where there is the panic. The panic subsides, the authorities come in, and in late 1929, the Fed actually did pretty much what it would do today. It went into the market and bought US Treasuries to keep interest rates down. It made reserves available for the commercial banks so that their balance sheets were... they will do the same. They will have to panic and cut interest rates. My guess is after we've seen something like a 30 to 40% fall in the S&P, they will cut interest rates. I can see the meeting, emergency FOMC meeting today. when that happens, I think markets will steady. This is what happened from around about November 1929 and ran through to around about May to June in 1930. Then the market started its pernicious decline. From having rallied about, regained about half the initial fall, you then had this long, pernicious decline down to a low level where the Dow fell, roughly lost 90% or 89% from the top by mid-1932. I won't describe the crises that came with it, like banks failing and all the rest of it. This is the sort of thing which we can envisage being repeated today. But you can see that the structure of the market, of the bear market, is actually quite clear in advance. We can see this in advance. So to summarize, you've got the initial crash, where everybody throws their toys out of the pram. We all get terribly worried. Banks start worrying about the value of the collateral they've got against loans, all that sort of stuff. The Fed comes in, has to rescue the situation. Calm is restored for a number of months, and then the real decline starts.
As time progresses, the U.S. economy is increasingly showing signs reminiscent of past periods of significant financial stress, such as the 2008 Great Financial Crisis. The high inflation and soaring interest rates of the 1980s, and even the precarious economic conditions of the late 1920s before the onset of the Great Depression. With a debt-to-GDP ratio now standing at 130%, the United States is among the most heavily indebted nations worldwide. Economic experts forecast the situation will worsen as the U.S. continues to accumulate debt, leading to escalating debt servicing costs. Some analysts fear that the U.S. could be following a path similar to Japan, which currently grapples with an alarming debt-to-GDP ratio of 260% and faces the looming threat of a sovereign debt crisis. Alasdair MacLeod, a well-respected analyst in the precious metals industry, argues that a return to the gold standard may be the only viable solution to avert a global financial meltdown. He suggests that those who invest in gold and silver now will be better equipped to weather the impending economic storm. We invite you to share your thoughts on Alasdair MacLeod's views regarding the future of the US dollar, gold, and the global economy in the comments section below. Remember to like this video, subscribe to our channel, and turn on notifications so you don't miss out on our latest insights. Thanks for tuning in, and we'll see you in the next video.